switch on the recorder again. So we're okay. We're now let's say we're now on the record. So thank you very much, everybody, for making time to come to our meeting. We have a meeting of minds, really, to discuss urgent actions for long-term success. I think there's a lot to unpackage here. We're living in very strange times, and I think everything we took for granted has somehow been turned inside out. And actually, the things we're living today, if you would have dared to speak about them as a prediction not that long ago, they would probably thought you were crazy. So it's really interesting how the world has changed and the kind of challenges we're facing. So I'm very excited to be part of this conversation because I think we have some very interesting people here where we can discuss and share ideas about how to navigate this rather difficult and confusing environment. So the thing is, to make this more peaceful, what I would like to ask you now is to briefly introduce yourselves. Give us in a little bit of a paragraph about what you do, what you're focused on, and why you're here and what you'd like to discuss today. So maybe we should start with Sandro. How's that, Sandro? You're the president of the Salsano group, right? Sandro is Alex.
Yes, yes. My CEO is. I'm using my CEO Zoom. Pleasure to be here. Thank you, Mohammed. Thank you guys for the invitation. It's nice to feel connected to the world. So my name is Sandro Salsano, and I'm the president of Salsano Family Office. We are a single family office with the main base in Panama City, in Panama. And we do mostly private equity, real estate, technology for the for-profit. And on the non-profit side, we focus on kids and education. And I'm happy to be here with you guys.
Thanks for that, Sandro. Leonardo, shall we go with you?
Okay, thank you. Thank you very much. It's a big pleasure to be here. Thank you again, Mohammed. Nice to meet you, Baldwin, and all the other guys. Thank you. So we are a family office based in south of Brazil. We started as a single family office. Now we are supporting a couple of families. I would say in Porto Alegre, Santa Catarina, and up to São Paulo. We started in 2005, so we are just about to be 15 years old family office, and we support our families in the process of wealth preservation. I'm a board member of 2 institutions here in Brazil, and I'm glad to be here.
Well, thanks for being with us. Bernardo, tell us a little bit about you.
Sure. Well, thank you very much also for the invite. I think I saw a lot of you last year when we did the event here in Bogota. So I founded my company, Grupo Atia, in 2015. We develop real estate projects in Colombia, mainly focused on affordable housing. And we also do senior housing. So we have the first assisted living platform in Colombia, where we both develop and operate the buildings. And lately, given the situation with COVID, we've been focused on telemedicine and home care.
Thanks for that. Germán, also in Colombia, I believe.
Yes, thank you everybody for the invitation. My name is Germán Aldana. I know some of you from the last year event as well. We are a multifamily office. Private capital is dedicated mainly for three families right now. Also, we are incorporating another one during this year. And thank you for inviting me to this event.
Well, thank you for being here, Germán. And finally, Alberto. We can't hear you, Alberto.
I was muted. Can you hear me now, Baldwin? Great, thank you. Thank you, everyone. Good morning, good evening, Mohammed. Thank you for putting this together, and hello to colleagues in Brazil and Colombia and other places. My name is Alberto Pagan. I'm based in Miami. I work with a multi-family office as well, about 3 families. That's one side of the business that we do, but on the other side, we develop technology to help our families and other to access a private debt, which has become quite important. So helping families to navigate this world of zero and negative rates. So again, thanks, Mohammed. Looking forward to the discussion.
All right, great. So let's kick this off. I mean, the subject of this roundtable is urgent action for long-term success, and some of the and I think that's kind of where we get what I've heard in the introductions. It seems like there's already a variety of topics that we could discuss. I've heard real estate. I think there are concerns about commercial real estate and its future right now, obviously with the isolation of people keeping in isolation. I heard something about debt and interest rates and returns, and I think we have a monetary a very strange situation. We have a lot of stimulus. It's been going on for a decade. It's even worse now. I think the thing there is that it kind of dilutes risk reward, because if you really fail badly, there's always going to be somebody handing out some free money, which is, I think, a problem for investors when risk is sort of like dampened. We have currencies which are probably shifting course right now because of this. We have increasing debt burdens and obviously low interest rates. So I think that's something that I hope we can touch on how to navigate this. We've got the retail sector, which needs to reinvent itself. And I think also, well, some of the other things that are, you can be concerned about or not, but it's the leadership kind of paradigm that we have today, and how policies are becoming quite subjective and difficult to gauge, really. So question is, how can family office navigate this current crisis and its potential aftermath? And I mean, what have you guys been thinking about to sort of like either cut your losses, or are you seeing ways to get to basically get out of this confusion and figure out a way to move ahead and try to survive these difficult times? Anybody volunteer to give us an insight on that? Because if you don't volunteer, I'll just appoint one of you.
I volunteer.
Okay, thank you, Alberto.
Yeah, basically, and again, thanks for that intro. I think what we're trying to accomplish is to tell our families and clients, you have to think differently. I mean, the world has changed, period. It's as simple as that in many, many functions. Taking the COVID-19 aside, we're not scientists. The world has changed. Central bankers are dominating the economy, the world flows, etc. So to put into perspective, what I tell clients on the outset is a 60-40 allocation for the last 40 years has generated about 10%. And the 60-40 is how I grew up in this industry. And
what is 60-40? I mean, is that equity debt or?
Yeah, I'm sorry. Thank you for clarifying. 60% equities, whether they are US or global, and 40% bonds or fixed income. So a 60-40 allocation basically has generated 10% on average for the last 40 years. So families, pension funds, and endowments have used that formula, which has worked extremely well. But here in 2020, and when you look out the next 10 years, you read research from JP Morgan, Goldman Sachs, the expected return in bonds is in the next 10 years is about between 1% and 2%. And on the equity side is about maybe 5 5 to 8, depending on the risk that you're willing to take. So overall, what we're looking at, it's is expected returns of 5-6%, which is almost half of what we've seen the last 40 years. So I think that is important, give them the numbers, give them that frame, because you have to think differently. The 60-40 was a great recipe when the world was working normally. Now is obviously the new normal, which includes central bank intervention, which includes anchoring interest rates down to 0, and in some cases negative. And that has to be, in my opinion, the first line of conversation. So they can, you cannot forget what you learned for the last 34 years, but you have to understand that all the factors has dramatically changed, and we have to think differently for the next 10 years.
All right, thanks, Alberto. Anybody want to add to that?
Yes.
Provide
Yes, I would like to complement what Alberto just said. One of the things that maybe is always relevant for our families is have the correct client's profile, risk profile, and also their asset allocation. It's something that we should never forget. Even though when the stocks are racing, or is a bull market or a bear market, it depends how we are working with the families and try to make sure that is the correct asset allocation for these clients. The situation right now is completely different. I mean, there is no manual or a book that tell us how we can work or try to navigate for the next 2, 3, 4, 5, 10 years in the future. And it's something that we are looking step by step and try to figure out how the things is going to behave in the midterm. So right now it's a difficult situation, a complex situation, but I'm glad that we were very I don't know how to say this, very strict in our asset allocation and in our risk profile of the clients. Right now, the challenge that we are facing is try to understand more than the books, more than the economic policies of the governments and how the business are going to behave in the near future. Because one thing that is for sure, that this is something that never contemplate that it will happen, and no one knows if they are going to happen again in 2 years, 5 years, 10 years. We don't know. So we have to be very cautious and very aware of the situations right now in the current environment.
All right. So we still have, let me see, Leonardo. I keep wanting to say Alex, but it's Sandro. Leonardo, any insights from your side?
Yeah, sure. So we understand that as a family office, we have to do a step back, and we have been doing something with the families very successful, which is the strategic planning for the family wealth. So basically, we understand that we have been in contact with very good entrepreneurs. They are very successful in managing their companies. But once we look to the family wealth, it's usually it's always a mess. So why they don't have the same diligence when we are talking about the family wealth and the business, the family business? And most of the time, when we start to do what we call the balance sheet for the family wealth, it's comparable with the family business. So why they have different treatments for the wealth, for assets? So we do this as strategic planning. We evaluate all their assets and all their liabilities for the next 20, 30 years. And if we think in a multi-generational process, we do for 50 years. And of course, this is crazy. It's very complicated to plan something for the 50 years, but what we do is we understand how their assets is going to be it's going to be evaluating for the next years, considering historical average returns for each asset class. And this is this provide them a lot of safety in terms of their investments. So Alberto and German was mentioning something regarding the endowments. So family, definitely, they are not endowments, and they have different needs regarding their liquidity. But the more we could approach to the endowment model, the more we are going to benefit for alpha and for better returns. So this is what we have been doing. We are not basically trying to avoid some asset classes. We accept the losses that we faced. And as you can see today, we are almost, we are already making money for 2020. This is completely crazy. There are a lot of liquidity in this world. So basically, we are investing much more in real assets, in real economy, sometimes through some private equities, some VCs. Here in Brazil, we like real estate. We have some really good opportunities. We're still facing some good opportunities in real estate in Brazil. Now we have very low interest rates, and going back to the strategic planning, we don't have inflation at this moment. So of course, we are going to face some difficulties for our investments, but in the other side, we don't have inflation. So our liabilities are going to have a smooth growth for the near future. So we are we are doing well. We are not facing mismatch in the customers' cash flows. We are comfortable. We are comfortable.
Well, thanks for that, Leonardo. And I think Bernardo, we still have to hear from you, right?
Sure. I'll jump in. I'm going to talk about the real estate aspect of this, right? I think it's definitely been one of the industries, at least in Latin America, that's been hit the hardest. I assume, it's been happening pretty much the same in every country here. But, you look at office, you look at retail, I think the problems that those assets were already having before the pandemic just became faster right now, right? So I think commercial real estate is definitely going to take a huge hit from this. Residential real estate, probably more of a short-term issue due to the banks and the lending. I think industrial real estate should be fine for the long term. Hospitality is a big one that's definitely taking a big hit right now. I think probably the bigger hotels are going to come out of this okay, but I think a lot of the boutique hotels are, definitely a lot of them are going to have issues with cash. What we are doing right now is we're focusing heavily on healthcare related real estate, which I think really is the big winner here, because for the first time, unfortunately, we are realizing that the healthcare infrastructure that we have in these countries is awful, right? And I think right now, countries, at least in Colombia here, they are realizing the need to heavily invest in healthcare infrastructure. In our case, we don't do hospitals, but we do assisted living facilities here. And we did see our occupancies go up on average 30% in the past 3 months. So we have received a lot of calls from the families that invest with us, wanting to be able to get access to more of these deals. It's something that's completely acyclical, which is interesting because you realize that healthcare is absolutely the number one priority for any family. They're willing to pay for this. So right now we're in the process of closing 3 new projects in Colombia. And we do think that assets that are related to healthcare are definitely going to be the ones that come out of the positive side of this.
Excellent. Mohammed, do you have any observations to make here?
For me, as a person coming from the Gulf region where we have several situations, I have experienced myself to wars. There is always losses when we have such situation, but at the same time, there is a lot of opportunities. As Bernard said, that there is now increase in the demand for the medical sector. For us here in Kuwait, we have a government call to be self-sufficient when it comes to food supply, medical supply, in general, to be self-sufficient. So if there is anything happen in the future, similar to the situation, we will not suffer as we had during the month of March and April. So when you look at it, there will be a lot of opportunities. Yes, we made a lot of losses, but I'm sure that with a new opportunity that arise, we'll cover this loss and we'll make a profit.
Okay.
Briefly on us, Balwin,
yes,
if you
yes.
want, just to touch base. You know, we have been, so for us, it has been a way to reset many things. For me personally, you know, I think it was, the pandemic has been positive in a way that I was traveling 2-3 weeks a month, and now I've been 4 months on an island in Panama, spending time with my son, who is 1 year old. And from a business perspective, I think many things have changed. So we are looking to adapt ourselves. We are adapting, obviously, some part of, we invest in real businesses. Some are doing it very well, actually. They've been very resilient. For example, the sector agro and logistics, where we have larger stakes. Others are not doing so well, like, for example, hospitality, hotels. And of course, nobody really know how long it will take for the recovery, as well as airlines. I would say as an allocation, you know, we've been increasing our gold exposure since January. We've been lucky, I would say. We raised cash, so we have a very strong, cash position at the moment. I feel that there is definitely a bubble in the stock market. There's been too much liquidity, and the government wants you to play with it. And so you have always Robinhood, and you have those Nikola, Tesla, Nasdaq 20% up year to date. So for us, it's a bit scaring when we see that everybody wants to, you know, buy because tomorrow is going to be higher. So we are on the fence. We don't see any real opportunity on the equity market at the moment. On the other hand, we are not short, as we think that you know, you don't want to bet against the Fed. So at the moment, we are focusing on specific projects where we think that we have an understanding and a good track record. So at the moment, for example, we are leading a $400 million round with other families in the logistic and in the agro sector. And we are looking for some dislocations in the market for the rest, which we don't see at the moment. We think that today it's very difficult to make money. You know, the risk reward curve is definitely not in our favor. We think there is probably some more upside in the market driven by the FOMO and the liquidity, and it's a year of election US, but we think the downside is much higher. I think nobody really can predict when we will have a vaccine and when we'll come out of the hood. So I think there is lots of uncertainty, and I'm very skeptical when I hear lots of prophets in the market on Bloomberg or anywhere where, you know, they tell you for sure when we're gonna recover. As I think it's prudent to say that we don't know. So the smartest people I spoke to and there are some in the rooms. I'm happy to be here, but I've been talking to Charlie Munger, I've been talking to Milken in the last weeks. They will tell you, I don't know. And I think that is the smartest answer we can have at the moment.
Yeah, thanks for that, Sandro. And excuse me if I left you out of this discussion. I apologize for that. But yeah, I think it's also an interesting sort of, it's not a cue for, I think you're right. There's something about, you have an artificially pumped up equity market. Probably you hear about banks making record profits, which is probably that they've got a new injection of capital from the state. So yeah, we have a total decorrelation between what, if you would look at the world only through equity markets, you'd say like, wow, what an amazing place. But no, the reality is different. And I think you're right. If you could say like, I don't know, it's a very difficult area to chart. But some of the things that I've heard during the conversation is the real assets. When you guys think about real assets, what does that mean to you? What kind of opportunities do you think are the most interesting there? A real asset obviously is a kind of asset which supposedly is decorrelated from capital markets and gives you a return on an ongoing basis. What's on your mind these days in terms of real assets? Alberto, maybe, or?
Sure. Sure. On the real assets, actually we don't do real assets per se. We focus more on the private credit, but it falls a little bit within real asset, and we do advise our clients and tell them what do we see in the real asset. Infrastructure, for example, has been quite busy these days because of they're mostly, toll roads, hospital facilities, etc., and they've been challenged by COVID. But real assets basically are like Bernardo mentioned, real economy, and Leonardo also mentioned as well. Real asset could be from commodities to timber, farmland, properties, real estate, where Bernardo is involved. Where Sandro is involved in logistics business. REITs are, private REITs is also a real asset. So basically those assets, as you mentioned, Baldwin, that are not publicly traded, therefore they do not have the daily correlation that we see in the market. Having said that, however, we warn our clients that every asset, whether it is publicly traded or non-publicly traded, you do have risk factors, no? And one of those risk factors is the equity risk factor. So there's correlation. For example, in infrastructure, there's a significant equity risk factor within the return of its infrastructure projects. So even though there is real assets and they are not publicly traded, you have to be careful and understand that there is some correlation to equities, much less, which is what we like and what we advise. But we remind clients that you still have to manage some of that risk and diversify from the equity-like returns that you're trying to avoid. So again, those are the
yeah, what I'm kind of fishing for here is, like, apart from the real estate or the typical type of real asset, I mean, have any new ideas come up recently? Have you come across interesting ideas that you find quite compelling and haven't really given that much attention to before? Has anything like that happened?
Is a question for me?
General, I'm asking everybody here.
Okay, so what I have seen in the private credit space, which is what I'm focused on, while we have seen opportunities. One thing that resonates to the managers we allocate to is what Sandro said. Sandro just mentioned that he raised some cash for the last couple of months. I would say over 2019, over that period, the last year, we came across with managers that were concerned. No, the market kept going up. FOMO, like Sandro said, fear of missing out, was already playing out. And what we saw in the credit markets, in the private credit markets, is were managers that were very aggressive and buying everything from high, expensive hotels to little covenants. So what we focus on, therefore, is we focus on managers that were raising cash, that they knew things were getting frothy, getting expensive, and therefore they kept a war chest, actually on average 20% cash. So why I'm saying that is because what we're seeing today, to answer your question, is that you will see private equity investors, and I think this applies across the board, not just private credit, but in private equity, private real estate, private credit, you will come across with managers that were conservative, have today 20, 25, 30% cash. They will be buying assets in the secondary market from those managers that were extremely aggressive. They were the newcomers, they had cash, and they were very active bidding prices up. Moreover, some of those managers were using leverage, and leverage works both ways, no? And in a downturn, it can kill you. So what we're seeing today, again, to answer your question, in the secondary market, you have managers doing some forced selling. So you can acquire a reasonable asset, whether it's private equity or private credit, which is what we do. So I can get a reasonable good loan from a reasonable credit, a loan that will mature in 90 days at 85 cents or 90 cents. So the credit is good. What's the problem today is the manager being forced to sell because he or she used leverage. So again, those are the opportunities that we're seeing. Managers that were not experienced.
So you're on the receiving end of that, okay, of that sell-off.
So you will see forced selling, and that's the other thing I like to mention to clients. You will see forced selling, and that forced selling is not necessarily related to the assets. It's going to be related to those managers that were too aggressive and had too much leverage. And we're starting to see that. And I think we'll see more of that.
Maybe I can ask my question to the whole group a little bit more concrete. So for example, okay, so what we have is a monetary system which is obviously being stretched to, when I speak about that, it's the financial system in general. It's being stretched. So I mean, comes up as crypto money, something that you're thinking about, or I think what we have is also you have a bit of a supply chain disruption, obviously. So one of the things that come to mind is food. Are things like urban farming? Is that something that you're looking at? I'm kind of looking for things like very new ideas, which may not have gotten much attention before, but may be able to come into the focus right now. I guess, with the proliferation of creative investment structures, which is SPVs, and the amount of people that can structure investments for you. I mean, direct lending to SMEs, crowdfunding, things like that. Have any of these things surfaced, or is that not something that your clients absolutely want to listen to? Or I'm just really curious about what they're thinking.
Baldwin, so let me take the floor. So when we look in real assets, as I mentioned before, when we talk about Brazil or Latin America or emerging markets, we would like to invest in more not so sophisticated ideas. When we go in this deep technology, we prefer to invest for example, in technology, innovation, and these ideas in Israel, most of them in Israel, and some of them in Silicon Valley. Here in Brazil, basically, you just have to deliver the simple things, or in the emerging market. So if you go to the US, for example, and if we are talking about some water, for example, then you have to have a very nice design. The water have to have some smell, some flavor. You have to put a little bit of flavor. Very nice design. You are going to invest a lot of money in marketing and so this stuff. Here in the emerging markets, we just have to make sure that we are going to deliver in the right time, in a very nice box, and that's it. Very simple. The multiples are smaller than we are expecting in developing countries. So so for us, it's different strategies. If you really want to have something sophisticated, then we go to the Silicon Valley and Israel. We have been seeing very interesting things, especially when we talk about deep technology. And here in Brazil, a more not so sophisticated ideas and initiatives.
Sandro, I saw that you also have some involvement in technology as investors. I'm just curious to know what your thoughts are. What do you find interesting?
Extremely negative. I think that, there is a, we started investing in technology 12 years ago. And I remember, we were lucky to invest in even pretty early in Uber, in Airbnb, some of those most famous names. And even at the time, valuation didn't make any sense to me. We've been always a value investor, but I always believe in people, and I was mostly investing into the team, although there was no business at the time. I do think that seeing the Nasdaq 20% up here today doesn't make any sense, and really, I think that the valuations went bananas. You have a truck company that is worth $25-30 billion, zero revenues. You have Tesla that is worth 250 billions, more than Toyota, more than Disney, more than you can add lots of companies there. And so there are some companies that obviously they have a strong monopoly. Look at Amazon, let's say the $1.5 trillion club, as we call it. Look at Apple, look at Microsoft. But I still believe that today is not a good moment to buy anything there. And of course, the market likes to look for comps. So if Tesla is trading at 1,000 times earnings, you might find some companies that say, hey, if I traded 500 times, I'm a bargain. So I think that for us, it's not our game. I think that many people will really lose lots of money, especially retail Robinhood guys. And I speak constantly. We have an office in Silicon Valley. We have a good team. We still have a portfolio. We've been exiting actually the last 3 years. There are still some companies we can exit. But for us, it makes more sense to go into real businesses and real asset. And as you guys were talking at the beginning, for us in this moment, for example, a very unique asset where we are investing this year is the free trade zones, and with an angle more agro, because free trade zone is not only logistic, but it's also a very high entry barrier. It's very difficult to invest in this asset because it's very difficult to actually get a license. So we like actually companies that have very high entry barriers, especially if they are in difficult markets like Latin America, for example. because it will take you, 5 years just to get a license. So if you are Amazon, if you are a large logistic group like DP World or some of those big guys, Prologis, even for them, with all the capital in the world, will take them, very long process. It's very legal. You have to go through several ministers to get, the license, the concession. And so this, for us, those are very unique businesses and a very unique angle, especially because on the agro sector, because we did a deal with a large vertical farming company. And I think this is really where we want to be. So really applying some of those technology on the ground that I can understand, but really the valuations on the tech don't make any sense. So we will stick to real asset, and I would say within the real assets and the real estate, if you ask me, I wouldn't touch anything that is those days commercial and hospitality, although we have a portfolio on the, pretty large on the hospitality side. I think that the retail really, and this pandemic has been accelerating the digital area. The retail is shifting more and more towards, warehouses and industrial parks. So that's where our core will be. We already own 7 industrial parks, but we are looking to add more, driven by demand. And also, I would say the key for us is really to identify sectors where it's difficult to entry for other players. So I think this will be very unique. And then, you create semi-monopoly or you are an oligopoly. And those are great business, obviously, because, you can set the pricing, and that there will be demand for that, because on the agro sector or on the logistics side, on the distribution, many of those companies, will probably leave their retail shop, they will sell their office, their retail, and they will move in a warehouse. So this is the way we see it going forward. And we've been very busy, as I told you before. Last 4 months, we did 2 deals, and now we are closing a third one with other families. So we are leading a round. There's a $100 million round. It's about $400 million deal. So we've been actually very busy. And we're very happy to share ideas. So happy to hear if there is any other interesting idea.
All right, and thanks for that. So we're sort of, we've spent all our allotted time for this call. So I think it's time to sort of wind this up. If I may be a bit specific and maybe getting some a short feedback on the following. Let's say that private wealth usually mostly invests in real estate, right? I think we can all agree that that's very typical, right? So what happens when a family or an investor is kind of stuck with a commercial real estate infrastructure? It could be an office building, it could be a multi-commerce. What's the strategy in the short term? What are you recommending these people? Do you have any creative ideas on what can be done there? You can obviously wait, but I mean, is there anything that's worth exploring for these kind of investors?
Sure, I'll jump in. I think that's a very tough question to answer, because
I know it's really tough. That's why I'm asking, because I can't figure it out either.
Because for example, we've seen here, we've gotten calls from a couple of hotels that want to convert to assisted living, which makes sense, right? I mean, right now nobody's moving to the hotels. The occupancy is at 0% right now. So being able to turn these buildings around and use them for a real need right now makes a lot of sense. In terms of retail, I think retail was already going down, south prior to this. So I think it's just become a lot harder because, for example, you had a lot of people that traditionally didn't buy online. For example, baby boomers, right? They still prefer to go to the shopping center, to go to the malls. Right now, given what's been happening the past 3-4 months, you have these people that have adopted a new way of buying online. And I think those people are not even going to go back to the traditional retail once things start to open up. So I do think that it's going to be very tough for retail and both for office buildings. Believe it or not, I do think co-working spaces are going to make a comeback, just because I think a lot of big companies are realizing it doesn't make sense to invest so much money into an office space, because companies can grow or shrink in a matter of months or days, right?
Yeah, but
so
also
what they're going to look for,
a risk diversification perspective, it makes sense,
exactly,
right? If you have your employees in different infrastructures, it just makes sense, yeah.
Exactly. So I do think co-working spaces are going to make a comeback, because companies are going to want the flexibility to be able to move, right? So I think the traditional office space as we knew it, where you had a company come in and rent 2 floors or buy a floor, I think that's definitely over, right? In our case, what we usually look for, or for what the families that invest with us look for, they look for 3 things. They look for assets that can appreciate greatly over time. And you usually get that by 1, building at cost, and 2, building with a unique differential factor into the building. For example, whether the building is LEED certified, whether it's EDGE, something that can create value out there, right? The second thing they look for, obviously, is consistent cash flows, especially right now. And then the third thing they look for, which Sandro mentioned earlier, was you need to have some type of barrier to entry, right? So in our case, we try to create what we call value-added real estate, which is adding an operational component to the real estate that can take those cash yields that you usually see in multifamily or retail, that can be, you know, between 6 to 8% a year, take that up to 12 to 15, right? And if you're able to create that operational aspect into the real estate, and be it something that is very hard to replicate, I think that's what the key for the success is. Sorry.
In fact, that's some good takeaways there. All right. So
my advice is that
yes, okay,
if you own a commercial tower like we own, you go to the beach and you forget about it. You know, there is nothing you can do. Unfortunately, you know, it's just a very bad place to be. You know, if you get a very low bid, I suggest you take it. I would take it. I think that, you know, there is no way we're gonna go back to the where we were pre-COVID. I was on a panel actually last week with the Financial Times, and there were 10 CEOs of big multinationals, Thomson Reuters, and some very large companies. Actually, 7 out of 10, they were telling me that they are looking to sell their towers or reduce their workspace. You know, employees, and also I look at my team, they like to work from home with the survey. So even for our case, we have offices all over the world, from Shanghai to, you know, San Francisco, London. Some we own, some we rent. I probably wouldn't, I probably would sell the majority and close the leases in some cases. You know, I think that you can be very productive working from home. And obviously there is a balance of work and the personal life. You tend to work more. Although I tell my people, you know, the weekend they should stay with the family, they shouldn't be working. So I think that we won't go back. It's like the airline in a way. I think it's one of those sectors where, you know, if you, you know, in the airline you have 16,000 planes that are not flying, you know, so there is no way, you know, you're gonna go back to, not even in our wildest dreams, to where we were before, you know, even if you assume that capacity goes back to 70% in 3-5 years. There are just way too many planes, and there is just too much commercial real estate. I think
it's
that,
a pandemic super spreader, right? Yeah. It's the
so sometimes, you know,
you
you do a bad trade, you make a bad investment. It's part, you know, you can't get it always right, and I guess, you know, and we have, as I said, we have a large diversified portfolio. So if we are able to exit the commercial, you know, I'll be very happy. But for the time being, I think there isn't much you can do. I'm afraid you can buy time, but I think things will get cheaper. And you know, and in many cases, if it's owned by, if you have a big loan, the bank will probably take over eventually. So I think that it's just a bad sector to be. It's just a bad spot to be.
No, no, it's
unfortunately.
fine. Thank you for that. It's absolutely fine to fail sometimes. You know, you make mistakes. It's fine. That's again that golden old advice of diversification. All right.
Yeah, I will. Yeah, Baldwin, I will echo what Sandro said, and besides,
Okay.
trying to take clients, think differently. You be flexible, be open-minded, because those real estate properties are worth less. Don't. I understand the attachment of some of these properties, generational, etc. But you have to, again, think differently, be open-minded. The world changed. It doesn't mean that you made a mistake. It just things change, and you have to adjust and move forward, because it can get cheaper.
All right. Okay.
Just to give you a little bit from our side, we
Okay.
do have some hotels, not big hotels, but small hotels located in some downtown areas. And definitely it was very tough for this business in the last years. So we were lucky. We found a good company here in Brazil. They called Housi. So we are investing together with them to remodelate this hotel. So we are not working as a hotel anymore. We are just renting these small rooms for young people, something like as Bernardo said. So because they are very well located, and so we are selling it for investors, so they can put for rental. We do all the services. We provide all the services for a very new idea of accommodation or hospitality. But if they want to live in these areas, they can do also. We are moving in this sense, because it was very tough to hold this as a hotel.
Yes, right now, for example, there is, we, as I mentioned before, we don't have a manual, and we have to see how the things behave in a short period, because there is a crisis of health. It's not and that concatenate in an economic situation. Right now, for example, we are looking for, we are open to see other type of opportunities, other type of businesses, other type that makes sense according to our asset allocation and our risk profile. And as Alberto mentioned it, that is something that we have been working with our clients, try to educate them to accomplish with this new reality that is happening. And as I mentioned before, there is a situation that we have to look very carefully and try to see, and sometimes try to manage the situation. For example, in terms of real estate, we have some real estate thing that is leveraged with one credit operation that we have right now, and they are empty right now. So what is the situation? Should we take that building, or try to make a negotiation with the debtor to try to recover our money? Or so that is a situation that we have to manage, because we never imagined that this situation will happen. So the important thing is, don't waste a good crisis like this one, and try to understand and learn more about this.
Fantastic. Thanks, Herman. Mohammed, would you like to give us a few closing remarks, sir?
As I said earlier, Baldwin, during this time, we all made losses on the government level, private level, but in the same time, there is a lot of opportunities, and there is a lot of people who make money during this pandemic. So for us, as a family offices, we just need to look to minimize our losses, because we cannot do nothing beyond that, and try to make use of the new opportunities arising. That's the only way to overcome this pandemic.
I guess the good news is a lot of cheap money coming our way, right? Let's see if we can catch some of that. Okay, everybody, muchas gracias, muito obrigado, shukran. I see that Leah was there. I don't know how you say this in Korean, Leah, but it was wonderful to have this conversation with you, and I hope we can get together like this or in person many more times and speak about many more things like of interest. So thank you very much, and thank you to Team Mea and Mohammed for organizing this.
Anytime.
Thank you very much, guys. Thank you.
Thank you very much for the invitation.
Thank you.
Thank you, Mohammed.
Thank you. Have a good day.
See you.
Thank you, Mohammed.
Bye-bye.
Thank you, guys.
Bye.
All the best to you and families. Stay safe.
Take care.
Thank you.
Thank
Take
you.
care.
Likewise, bye.